The first quarter of 2020 saw the Singapore market post its worst quarterly performance since 2008. With a decline of over 20%, all of the STI's component stocks were in the red, except for the Singapore Exchange. A spike in derivative and equity trading volumes has been a boon for the bourse operator.
The 5 most defensive STI stocks in the 2020 year to date have been Singapore Exchange, Mapletree Logistics Trust, Venture Corporation, Ascendas REIT, as well as Dairy Farm International. These 5 stocks have averaged a 5% decline in the 2020 year to date, and they are typically leaders of their field or they have very diversified customer bases.
Around 645 million Singapore dollars in institutional money has flowed into the STI's top performing stocks since the start of the year. But big bucks have also been withdrawn from the least performing constituent stocks. Transport plays continue to be among the biggest losers in the pandemic-led market frenzy.
ComfortDelGro Corporation, SATS, Singapore Airlines, Jardine Cycle and Carriage and Semicorp Industries. Together these 5 stocks have averaged a 33% decline in the 2020 year to date. And if you do look at the, let's say the top 100 stocks of transportation sector across the world, they've also averaged in-line declines of around 35% in the 2020 year to date.
In the widespread indiscriminate selling across the globe, Singapore and its regional peers have not been spared.
The STI's 20% year-to-date decline compares to a 24% decline for the FTSE ASEAN All-Share Index. Basic materials and the oil and gas sectors have weighed the stock exchanges in Singapore, in Thailand, Indonesia and Malaysia. And that would be expected given we do have a higher correlation with the price of oil across ASEAN markets than the broader Asia Pacific region. And of course we did see the price of crude oil decline by some 65% in the first quarter of 2020.
Falling oil prices and several headwinds aside, Phillip Securities says there are still reasons to be optimistic.
Globally, governments are aware and taking the right but again painful measures to contain this virus. We have seen containment in China and South Korea. Other reasons include the unprecedented fiscal and monetary stimulus and attractive and cheap valuations. Historically, it has been profitable to buy into massive sell-offs.
Over the last 30 years, 15 of the worst market sell-offs have generated attractive gains, averaging nearly 30 and 50% in the 6 and 12-month periods after the market crash.
We expect the STI to recover from some of the losses experienced in first quarter 20. The largest headwind is the continued rise in new COVID-19 patients globally. Until we experience a peak or plateauing of new patients, more economic restrictions or pain will be needed to contain the spread.
For now, sectors that pay good dividend yields and have strong balance sheets to support payouts are in favour.
Our preference is electronics, REITs and banks, such as Venture, Escort Trust and UOB respectively. We are generally underweight sectors that were structurally challenged even before this current outbreak, namely the large marine yards and transportation.
In a report, DBS says 3 investment themes will likely prevail amid the COVID-19 pandemic. The first is focused on survivors, which are companies with low gearing, good cash flow and earnings visibility. Next are the resilient stocks that can withstand short-term supply chain disruptions, a sharp drop in consumer spending and the impact of travel restrictions. The third are stocks that can benefit from China's return to normalcy.
The attitude of investors should be twofold. Firstly, to buy and value a company on its normalized earnings. Avoid valuing the company based on this year's earnings that will be negatively impacted by the virus, at least in the short term. Secondly, the markets are volatile. Take advantage of the volatility and buy in phases. Do not look for that elusive and expensive bottom.
while the dips in stock markets provide buying opportunities, some experts warn of more sell-offs ahead.
Even though you have large rallies, it's more important to understand that no equity market in the world is safe. All equity markets are down for the year, right? So this could be potentially the multi-year turning point, and it could actually lead us into a more meaningful bear market.
With COVID-19 cases still on an uptick, extended lockdowns also pose further downside, particularly for US equities.
Within the span of 3 months, you have the fastest bear market on history, and you also have an environment that is full of uncertainty. In a prolonged shutdown, we potentially could see price-earnings ratios on the main indices in the US potentially come down to 7 or 8. That would potentially be the S&P 500 index at 1,500 on the index level.
As the race for an effective treatment or vaccine continues, one sector will be in favor.
One area that increasingly we like and many investors increasingly will look at more is healthcare. Because I think one of the reasons why this sort of has been such a surprise and to many people in the United States is because there was underinvestment in those basic humanitarian and basic healthcare, right? So again, anything that is related to healthcare and well-being, those sort of stocks potentially could do well.